Welcome back to the channel, everyone. My name is Nick Armenis, and for those of you that don't know, on this channel, I mainly cover off the ASX stock market news, recommendations, ideas, and just my thoughts on the market. I also have started covering off US stocks as well, so have a look around the channel if you're interested. But in today's video, I'm going to cover off the ASX buy now, pay later sector. I'm going to review the sector. I'm going to cover off what's good about it, what's bad about it, my thoughts on where it's going, and then I'm going to actually do a little bit of analysis on Afterpay and Zip, as some of you on the channel in the comments have been asking me about it. Okay, guys, before we get into the video, please give it a thumbs up, subscribe to the channel, and hit that notification bell. You'd really be helping me out. Okay, so before we get any deeper, guys, just remember, this isn't financial advice. I'm just giving you my opinion on this sector. Okay, so what am I going to cover off? What do the buy now, pay later stocks actually do? My thoughts on the sector. Then I'm going to cover off Afterpay and Zip and do some analysis on both of those. Okay, so how do buy now, pay later companies actually work? So some of you probably already know this. So if you do, just skip through to the next section of the video. But if not, stay tuned and at least brush up on exactly how it works. So guys, most of the time, this is known for being big online, and that's kind of where it started, but it is also in physical locations now as well. So obviously a physical location will be a little bit different, but online, basically someone orders on the website and they choose to pay with a buy now, pay later website. It's very easy. These actually integrate into websites very easily. I've done it myself multiple times. The items are then obviously delivered to the customer. The customer makes payments, right, on the agreement period. But basically what happens is you will normally have a small upfront payment, and then the rest of it will get split up over a number of purchases. That's how normally it'll work, right? Now, on top of that, the great thing about it is obviously the customer is going to pay the buy now, pay later provider, but the merchant, the website, the person selling it, gets paid by, Afterpay, Zip, and all these companies straight away. It's really, really good for them because obviously they get the money up front, the customer gets the product, right? So how exactly does it work? Merchants, so exactly why do people use it? Why do merchants use it, right? Merchants use it, so the people selling use it because they get paid upfront for purchases while growing the conversion rate in sales. So the conversion rate on a website is out of how many visitors that actually go on the website, how many actually buy, how many make a sale. It also increases the value of a sale, the average order value, right? So the buy now, pay later provider clips the ticket, they get a percent of the sale, which they charge to the merchant, not the customer. So the customer really benefits from this, right? The customer benefits because it's convenient. They can pay off purchases over time rather than having to pay for the whole product up front. So people really like it, right? They then pay the buy now, pay later provider, and then any late payments attract penalties, right? So these are the ways that the actual company makes money. It's a win-win situation because the online store, the online business, or retailer at that makes more sales, gets a better conversion rate, and then the customer gets to buy something that they may not have ever even bought, right? They may not have had the ability to at the time, and so wrong or right, it's a cash flow management tool. And if used correctly, there's no issue with it. Now, obviously, some people don't like it because people are buying things they don't need, especially older people. But in today's day and age, credit is money, and that's what people fail to understand. As long as you can meet those repayments and you stay within those limits, which these companies do put limits in place. It's not an unlimited amount, and they do tend to have quite low default rates on this, right? So, which is really good. And in my opinion, win-win businesses are the ones that really explode. And so that's why these businesses have exploded, because it's a win-win. Think about it. Mortgage brokers, win-win. Mortgage industry grows, right? Anything that becomes a win-win on both sides is normally a pretty good business. So these are my thoughts on the sector. The good, these businesses are in a huge industry, guys, and are becoming global players. So a lot of these businesses now, even the Australian ones, have gone to the global stage, to America, the UK, etc. And the global payments industry is a $2 trillion industry annually. That's from McKinsey Global. I did not just make that up. These businesses have reached a huge penetration point. So basically, if you sell online, these are almost necessary, right? If you do not offer these, your sales will not be as high as they could be. And so they're needed. They're just like a credit card now, right? But they're actually more popular in Australia than credit cards, right? People actually love them. 6.1 million, or 30% of the population, have a buy now, pay later account, and that's from the government's own review. They operate a win-win business model, as I said, which is an awesome factor. Revenue, customers, transactions are all growing really, really fast, in over 100% kind of period on period increases. The data they hold is extremely valuable, and this is a bit that doesn't get talked about a lot, I don't think. But they can do things like cross promotions, utilizing AI to make recommendations to customers based on what they've bought. And they can sell this to merchants and to other people, right? If they so choose. They're able to drive traffic to merchants through their own websites and apps. So these businesses now get huge amounts of traffic. And so the great thing about that is if you're a business owner, you go run an online store, you want customers, they can send them your way. This is a great thing for them, right? Think about Google and Facebook. The reason they're able to charge so much for their ads is because they drive buyers to online stores or businesses, right? And this is the great thing about this industry. So it definitely has a lot going for it, guys. Now the bad. To my knowledge, none of these businesses are actually profitable, which is a problem, right? Interest rates are slowly going up. You've seen what's been happening with tech stocks, and even to these stocks, they've definitely come down off their highs. This is going to increase borrowing costs. And the problem with the buy now, pay later stocks is they borrow money to then obviously not lend it out, but give it out and then clip the ticket, right? Unfortunately, they're holding on to those as loans and they're paying interest on that money. So if interest rates do go up quite high, these businesses are really unproven in tough economic times, right? Which is my third point. We've not had a tough economic time for quite some time. COVID was a boom for these businesses, but a high interest rate environment or, an environment that isn't suitable to this business model, it hasn't been tested or proven. So I don't know how it's going to go there. So longer term, I don't know how these businesses will go because of this factor. Competition's heating up too, guys, which, isn't great. You've got PayPal entering. There's lots of other competitors, Klarna, lots of other international competitors as well. And Commonwealth Bank just this week released their own buy now, pay later service, which will definitely be pretty popular at some point. And I know this has been on the radar for some time. I think regulators will shake it up. I actually lost quite a bit of money at one point having cash converter shares, and I've learned that any industry where it's kind of in a morally questionable area, and you may think it is or isn't, it doesn't matter. If the government gets involved and ruins it, this could ruin this business model long term. My verdict, the big fast money has been made here. Personally, I bought Afterpay at around $2 a share and I sold it at 17. So my shares right now would have been worth well over 300,000. So obviously not the greatest sale that I ever made, but I think still the fast money has been, particularly in Afterpay, has been made. I do believe there's scope for the industry to grow, but it's going to be harder with the competition. I'm not saying these businesses won't grow. I just don't think they're going to grow as fast as they have been, right? And high PE, unprofitable stocks at the moment are getting hit really, really hard, and they will continue to do so as rates go up because it impacts their margins, and they're already not profitable. I'd be cautious here to select the best stocks in the sector, right? You don't want to go for the ones that are so-so. You want to go for the bigger players, and that's why I'm going to cover off Afterpay and Zip. Risks will be high, so don't allocate a huge portfolio here, guys. I wouldn't be betting the farm on these. These are stocks that are still in a growth phase, but definitely, over the next 2 years, there's a lot of competition, and I just don't think they're going to grow quite as fast because, as we'll see, Afterpay, so the ASX ticker APT, it's a $31.65 billion stock, and it's come down from around 40, I think, because it's trading at 111 at the moment. But its 52-week high was 160. So it's come down quite a bit, guys. Now, is it a good buy right now? I still think potentially there's a bit more to go down. I think around me personally, I'd probably be interested in this around the $80, $90 mark, depending on how the market's going. But to be honest, I wouldn't be surprised to see this back at $50, $60, just based on what's going on at the moment. $31 billion for this business is actually incredible, guys. Like, it's not making any money. And yeah, maybe one day it will, but we don't actually know that. So to now think that this is going to double again and become a $60 billion company, I don't know. It potentially could be now, but after that, could it quadruple again and become a $120 billion company? I don't think so. I don't think this is at the size of, Visa, PayPal, all these sort of businesses. It's just not at the same level yet. It's unproven. Could it potentially? I don't know. But you're then talking about it, this business being, bigger than some of the big four banks. Is it yet? I don't think so. You know what I mean? That said, one bit I did miss is these guys can get into a variety of other industries or other services and offer their products to their customers. So they may be able to actually grow their way out of this. And so I wouldn't be, if you're in this already, I wouldn't necessarily be selling it as a long-term, holder. I just don't know if now is the perfect time to get in, especially if you're kind of, in it for short term. I think it's got a little bit left to drop back, guys. And even after that, even just wait to see if it holds that $100 level, then potentially, it may still run pretty hard. If you're a long-term buyer, so if you're looking to hold this for 3 to 5 years, I still think there's money to be made in this stock. But what I will do in another video is I'll actually go into each one in detail. But what I'll quickly do now, guys, is I'll actually show you the financials briefly, just so you understand what I mean if they don't actually make money. So I'm in ComSec here, and I go to financials, and these are their earnings. Negative return on equity, right? Sales obviously increasing, cash flow not so much. Is obviously still negative. Sorry, earnings negative, no dividend, right? If we go into the actual revenues though, this is where we're seeing the big growth, right? So these guys pretty much double consistently. Look at this. They're just, that was more like a triple or quadruple. And even to this point, they're growing quite fast, right? They're growing revenues. If you see here, they've gone from 22 million, 113, 218. They're doubling, right? Obviously, some of this would have been COVID, but can they get to 900 million in revenue? Well, let's wait and see. I'd like to see the next earnings. They're actually getting positive EBITDA now, which is interesting, but still, net profit is still negative. They're spending money on growing this business. So, look, guys, I actually really quite like Afterpay. It'd still be my pick of the bunch for a long-term hold, but I do believe the Zip, and I'll get into that, if you're wanting more of a short-term hold, is probably going to be a bit better, just because I think it's easier for a $4 billion company to become an $8 billion than it is for a 30 to become a 60, just me personally. I think overall, though, that Afterpay is the better business here. And as we'll go into the balance sheet, and if we go and have a look at their long-term debt, as you can see, this, Afterpay carries quite a bit of debt at the moment, 464 billion. And if we compare that to Zip is actually carrying even more long-term debt. So, I mean, if I was to trade it, Zip's probably going to be my trade. Afterpay is going to be my longer-term hold. But that's just me personally. I'll go and cover off Zip now briefly. So Zip, ASX ticker Z1P, it's trading at $8.47, and its 52-week high was 14. Its 52-week low was $1, which is incredible, right? You would have 8x your money. Market cap of 4.68 billion. Again, I wouldn't be surprised to see this around that $6.50, $7 again, and then it'll probably trend on upwards as long as it has a half decent earnings update. But yeah, guys, the competition's heating up. Zip just isn't as good of a business in my view as Afterpay. It's not as well known. Afterpay has that competitive first kind of mover advantage here. It's used more. It's got that. Once you get customers in this, guys, it becomes very easy to grow your earnings once you've already got them, right? Customer acquisition costs for this sort of stuff can be quite high. And so once you've got them, it's easily to add money to your, revenue and eventually bottom line. So, I mean, if we quickly go in and have a look at Zip's performance. So again, earnings negative return on equity, but again, definitely growing fast as well. It's just not as impressive as Afterpay, guys. It's still much, much smaller than Afterpay at 157 versus million in revenue versus 450 here. And if we look at transaction volumes, 140% up, revenue 130% up, 106% in underlying sales. Customers are growing a little less quickly here, but if you have a look at Afterpay's active customers, it's incredible, 13.1 million active customers, guys. So I'm not sure if they have this on the same here. Transactions up 248%. So yeah, last quarter, Zip grew a little bit quicker in percentage terms in some of these, but the numbers that you're looking at here, Afterpay just has far, far bigger numbers that they're dealing with. And I think eventually we'll be able to monetize that far better than Zip. Just my opinion, guys. Do your own research, but I hope this video has helped you out. If you did like it, give it a thumbs up. Let me know your thoughts below on the video, and I'll see you in the next one. Cheers.